Let's get to it. 10. Buy, borrow, die. Picture a man living in a $100 million Bel Air mansion. He drives a Bugatti, wears a Patek Philippe, and eats dinner at Nobu every night. To the outside observer, this man is spending a fortune. But if you looked at his tax return, you'd see something baffling. His income is effectively zero. In fact, on paper, he's poorer than the waiter serving him his sushi. This isn't fraud, it's a financial magic trick that forms the bedrock of the billionaire lifestyle. The IRS taxes income, but it doesn't tax debt, and that distinction is the key to the kingdom. Here is how the buy, borrow, die strategy works. A billionaire like Jeff Bezos or Elon Musk doesn't keep their money in a checking account, they keep it in stock. If they sell the stock to buy a mansion, they have to pay a 20% capital gains tax. That's a loss. So instead, they go to a bank and say, I have $10 billion in Amazon stock. Lend me $100 million cash and use the stock as collateral. The bank happily agrees, offering interest rates as low as 1% or 2%. The billionaire now has $100 million in spending cash. Since it's a loan, it's not taxable income. They spend it freely, and the meager interest they pay to the bank is vastly cheaper than the 20% tax hit they would have taken by selling shares. The real magic happens at the end. When the billionaire eventually dies, their heirs inherit the stock with a step up in basis. This tax code quirk resets the value of the stock to its current price, effectively erasing all the capital gains taxes that built up over the billionaire's lifetime. The heirs sell a sliver of the stock tax-free to pay off the bank loan, and they keep the rest. The bank gets its interest, the kids get the fortune, and the government gets absolute zero. But while borrowing against assets is a clever way to avoid taxes, some billionaires prefer to use a vehicle meant for the middle class to hoard billions. 9. The Mega Roth IRA. The Roth IRA was created by Senator William Roth in 1997 with a specific promise to the American middle class. Pay taxes on your money today, put it in this retirement account, and when you're 60, you can withdraw it tax-free. To ensure it wasn't abused by the ultra-rich, the government capped contributions at a few $1,000s a year. It was designed for steady, slow growth, a safety net for nurses and teachers. But in 1999, a venture capitalist named Peter Thiel looked at this middle-class safety net and saw a loophole the size of a bank vault. Thiel didn't put cash into his Roth IRA. He used the $2,000 contribution limit to buy 1.7 million shares of a then startup called PayPal. At the time, the shares were valued at 0.001 each. It was a high-risk bet placed inside a tax-exempt wrapper. When PayPal exploded and was later sold to eBay, the value of those shares skyrocketed. Because the explosive growth happened inside the Roth IRA, it was shielded from the IRS. By 2019, ProPublica reported that Thiel's humble retirement account had ballooned over $5 billion. Normally, turning $2,000 into $5 billion would trigger a tax bill that could fund a small country. But because this sits in a Roth, Thiel has one-time access to a tax-free withdrawal. He essentially turned a vehicle designed for modest retirement savings into a permanent, impenetrable tax haven for a fortune larger than the GDP of Fiji. It is perhaps the single greatest return on investment in the history of finance. But while Thiel hid his money in a retirement account, the companies that generated that wealth were busy playing a global game of hopscotch. If you could visualize the path of a dollar earned by a tech giant, it wouldn't look like a transaction. It would look like a fugitive on the run. Imagine a customer in France buys a subscription from a US tech company. Logic dictates the tax should be paid in France or the US, but in the world of corporate finance, geography is a fiction. For decades, the most profitable companies on Earth, Google, Apple, Facebook, utilized a structure so complex it sounds like a bad spy novel code, the double Irish with a Dutch sandwich. Here is the blueprint. A US company sells its intellectual property, the rights to its software, to a subsidiary in Ireland. When sales are made in Europe, the profits go to this Irish company, but Ireland has a tax treaty with the Netherlands, so the money is moved there tax-free. The Dutch subsidiary then moves the money to another Irish subsidiary. Here is the catch. This second Irish company is legally headquartered in a tax haven like Bermuda or the Cayman Islands, which has a 0% corporate tax rate. The money bounces from Dublin to Amsterdam to Bermuda, never touching US soil, and therefore never triggering US tax. This wasn't a criminal conspiracy, it was standard operating procedure. By the time the loophole was finally pressured into closure around 2020, companies had shielded trillions of dollars from the US Treasury. They legally shifted profits to islands where their only employee was a mailbox. While the tech giants were moving money across oceans, back in the States, developers were finding ways to make fortunes by promising not to build anything at all. 7. The conservation easement. Imagine you buy a swampy plot of land in the middle of nowhere for $1 million. It's useless. You can't farm it and nobody wants to live there. But then you hire a friendly appraiser who looks at this swamp and says, you know, if you drained this, built a luxury golf course, a hotel, and a helipad, this land would be worth $50 million. You nod, agree with this fantasy valuation, and then sign a legal document promising that you will never build that golf course. You donate this development right to a charity, claiming you just sacrificed $49 million of potential profit for the good of the environment. This is the syndicated conservation easement. By donating the theoretical rights to develop land that they never intended to build on anyway, investors can claim a charitable tax deduction based on the inflated fantasy value, not the price they actually paid. For every $1 invested, a billionaire can get $4 or $5 back in tax deductions. It allows them to wipe out their income tax bill by claiming they are saving the planet, when in reality, they're just preserving a patch of dirt to game the system. Critics call this arguably the most egregious fraud in the tax code, a scam that costs the government billions while effectively subsidizing wealthy landowners to do nothing. However, libertarians and some landowners argue this is a brilliant mechanism that incentivizes private citizens to protect nature from urban sprawl, claiming the government is just angry it's losing revenue. Is this a golf course scam or a legitimate way to save the environment from concrete? I want to know where you stand. Let me know in the comments below. But while some get rich off land, others get rich by pretending to work for free. 6. The $1 salary. Every few years, a headline breaks the internet. CEO takes $1 salary. From Steve Jobs to Mark Zuckerberg to Elon Musk, the $1 salary is the ultimate PR move. It paints the billionaire as a selfless captain of industry, working not for a paycheck, but for the mission. The public applauds their sacrifice. But if you look closer, this isn't an act of charity. It's a calculated mathematical maneuver designed to dodge the highest bracket of income tax. In the United States, your salary is taxed as ordinary income, which creates a top marginal tax rate of 37%. However, capital gains, the profit you make when an asset like a stock goes up in value, is taxed at a maximum of 20%. By declining a $20 million salary and instead taking $20 million in stock options, a CEO effectively cuts their tax bill almost in half. They swap high-tax cash for low-tax equity. Furthermore, they don't pay any tax on that stock until they actually sell it, which, as we learned in point number 10, they rarely do. The $1 salary is a signal to shareholders that the CEO is all in, but it is also a signal to the IRS that they won't be paying income tax this year. It turns the concept of a wage into a sucker's game. But avoiding taxes on income is easy. Avoiding taxes on physical objects requires a much more secure facility. 5. Art storage. In a nondescript industrial zone near the Geneva airport, there is a complex of warehouses known as the Geneva Freeport. It looks like a self-storage facility, but it has tighter security than a supermax prison. Inside these climate-controlled walls sits the greatest collection of art in the world, more Picassos, Warhols, and Da Vincis than the Louvre and a Met combined. But these paintings aren't there to be admired by the public. They are there because the Freeport is a fiscal no-man's land. Here is the play. If a billionaire buys a $50 million Van Gogh in New York and hangs it in their penthouse, they owe a massive sales tax bill, often nearly 9%. But if they ship the painting directly to a Freeport, it is considered in transit. No taxes apply. The painting can sit in that crate for 20 years. Even better, the billionaire can sell the painting to another billionaire. The money changes hands, the title transfers, but the painting never leaves the warehouse. Since the asset never technically entered a country's jurisdiction, no tax is paid on the transaction. It treats priceless cultural heritage not as art, but as an alternative currency, a poker chip that gains value in the dark. The art world calls it storage, but in reality, it's a tax-free trading floor where the merchandise is never unboxed. But while art sits collecting dust, there is another asset class billionaires left to buy, one that sweats, bleeds, and apparently depreciates like a used car. 4. Sports team amortization. Owning a sports team is the ultimate vanity purchase. It's the billionaire's way of saying, I have arrived. But beneath the ego and the championship rings lies a tax deduction so bizarre it defies logic. When a billionaire buys a team like the Clippers or the Mets for $2 billion, the IRS allows them to treat the player contracts as depreciating assets. This is called roster depreciation allowance, or RDA. The logic works like this. The IRS views a star quarterback the same way it views a factory machine. Over time, the machine wears out and loses value, so the factory owner gets a tax break to offset that loss. Billionaire owners argue that athletes wear out too, so they can write off the purchase price of the team against their other income over 15 years. This allows owners to report massive paper losses to the IRS, pretending they're losing money, while the actual value of the franchise skyrockets. They get the prestige of the owner's box and a tax shield that can save them hundreds of millions. This brings up an uncomfortable reality. We're talking about a tax code that literally treats human beings as depreciating industrial equipment to save billionaires money. Economists argue this is just smart accounting for a business with high turnover. Social critics call it a dehumanizing loophole that commodifies people. Does this sound like smart business to you, or does it feel morally bankrupt? Let's argue about it in the comments. But while they treat players like machines, they treat the IRS like a casino where the house never wins. 3. The family trust. Imagine walking into a casino and making a deal with the pit boss. I'm going to bet $100 million on black. If I win, I keep the winnings tax-free. If I lose, I just take my $100 million back like nothing happened. It sounds impossible, but this is essentially how a grantor retained annuity trust, or GRAT, works. It is the weapon of choice for Silicon Valley tycoons looking to transfer wealth to their children without paying the crushing 40% estate tax. You take a highly volatile asset, say pre-IPO stock, and put it in a trust for 2 years. The IRS sets a hurdle rate, usually a low interest rate like 2 to 3%. If the stock's growth beats that low hurdle rate, all the excess profit passes to your children, completely tax-free. If the stock crashes, the trust simply dissolves and the assets go back to you. You've lost nothing but the lawyer's fees. It is a hence I win, tails I don't lose bet against the government. Mark Zuckerberg and the founders of Google have used grants to move billions of dollars out of their taxable estates. It turns the estate tax, designed to prevent the creation of an American aristocracy, into a voluntary donation that only the ill-advised actually pay. But sometimes moving your money isn't enough. Sometimes you have to move yourself.
2. Citizenship by investment. For the average person, citizenship is a birthright tied to soil and blood. For the ultra-wealthy, citizenship is a product you can buy on Amazon, provided you have the right credit card limit. When taxes in the US or Europe get too high, or regulatory heat gets too intense, billionaires don't just hire better accountants, they buy a golden passport. Countries like Malta, Cyprus, and St. Kitts and Nevis have turned their sovereignty into a luxury good. For an investment ranging from $150,000 to a few million, you can purchase full citizenship. This isn't just about shorter lines at the airport. It allows a billionaire to renounce their U.S. citizenship, a process called expatriation. While the U.S. tries to hit them with an exit tax on the way out, with the right planning and the loopholes we've already discussed, they can minimize the damage. Once they are citizens of a Caribbean rock with 0% capital gains tax, their wealth grows unimpeded by the needs of a society they left behind. It is the ultimate decoupling of wealth and responsibility. They become citizens of nowhere, floating above the laws of nations, paying rent to a government only when it suits them. But there is one final level, a loophole so effective it allows you to keep your money, avoid taxes, and be hailed as a savior of humanity all at the same time. 1. The Philanthropy LLC. When Mark Zuckerberg and Priscilla Chan announced they were giving away 99% of their Facebook shares, worth nearly $45 billion, to the Chan-Zuckerberg Initiative, the world wept. It was hailed as one of the most generous acts in human history. The headline screamed charity. But if you read the fine print, the Chan-Zuckerberg Initiative is not a non-profit foundation. It is not a 501c3. It is a limited liability company, LLC. This distinction changes everything. A traditional nonprofit has strict rules. It can't engage in politics, and it must give away money for public good. And LLC can do whatever it wants. It can invest in for-profit startups, it can lobby politicians to change laws, and it can make political donations. By transferring the shares to the LLC, Zuckerberg avoided the capital gains tax he would have paid if he sold them. And because he controls the LLC, he never actually lost control of the money. He essentially moved $45 billion from his left pocket to his right pocket, slapped a philanthropy sticker on it, and avoided billions in estate taxes. It allows the ultra-wealthy to convert their fortune into political influence that lasts forever, all while enjoying the public relations glow of a saint. It is the ultimate privatization of power. The yacht deduction. Since we have a moment, here is one final insult to your paycheck. If a billionaire buys a $300 million super yacht, complete with a helipad, a cinema, and a crew of 50, the IRS classifies it as a second home. As long as the boat has a sleeping area, a toilet, and a cooking facility, which of course it does, it qualifies for the mortgage interest deduction. That's right, the same tax break designed to help a middle-class family afford a vacation cabin is used to subsidize the interest payments on a floating palace. So the next time you see a billionaire partying on the Amalfi Coast, just remember, your tax dollars are helping keep the lights on. Closing. These loopholes aren't accidents. They are features of a system built by the people who can afford the architects. Which of these strategies made your blood boil the most? Or are you just taking notes for your first billion? Let me know in the comments. I read them all. Stay curious.